Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap featuring my good friend, portfolio manager Lance Roberts. Hey, Lance, how you doing?
Good. How are you today? Happy Easter.
Hey, same to you. And folks, this isn't quite exact a weekly market recap because Lance and I are filming this on Thursday, not our normal Friday recording. We're doing that because I am in the middle of a move. And so this whole studio you see here, hopefully this will be invisible to you, but just in case it's not, want to open the kimono, let folks know what's going on in the background here. You might see me in a couple of different backgrounds before we get this one here replicated at the new location. Folks always ask me, is this like a Zoom background or using a green screen? No, it's actual wood paneling, but it is affixed to this wall here, so I can't take it with me.
But today is Thursday, by the way, and tomorrow is the holiday because it is Good Friday, so markets are closed. So technically, it's kind of a Friday market recap, right?
It is. Thanks for reminding me. I had forgotten that. Yep.
So yeah, it's a weekly market recap.
All right. Before we get into the recap, folks, and I promise we got a lot of data to get into here. One funny little story that'll make you chuckle, Lance. You saw a Spinal Tap, right?
Oh yeah.
All right. So trying to get this same paneling to where we're going has been an absolute nightmare. It's been like a total comedy of errors. They don't sell at retail anymore. So I've had to track down the West Coast wholesale distributor of this stuff and finally got it through the purchasing process at this company and got it FedExed out to the guy who's going to rebuild this thing for me. And you remember in Spinal Tap when they jot down the dimensions for their Stonehenge set on camera, on a little piece of paper, and then they show up on stage and they got the feet and inches wrong, and it's this tiny little model. Well, so we had thought we were getting 3 boxes of this stuff, which is what we need to get the full background. They shipped out only 3 panels. So my guy who was set to work on it yesterday was like, how small is your set? Because I only have 3 little panels here to do. So hopefully, folks, by the time you see me next, I'll have the full paneling. But if not, we can all blame Spinal Tap.
There you go.
All right. Well, look. So as we look at the week's actions since we met last time, Lance, markets are down slightly, and there's a bunch of data that's come out this week that we're going to talk through. But I'm just curious, as you sort of look at the general action, is this just a consolidation based upon the big run we had last week? Are we getting into overbought territory here, or what is the TA telling you at this point in time?
Yeah, so very interestingly, this is exactly what I discussed in this past weekend's newsletter. So again, we'll have a new one out this coming weekend. We'll actually be talking about this massive surge in reverse repo balances, which are over 2 trillion now. So we're going through a full description of what that means and what that potentially means for the markets. But if we go back and look at last week's newsletter, is a good example. And here, let me just share my screen very quickly with you. This was something that we actually covered on 2 different fronts. So first of all, we talked about this run up since the beginning of the year being roughly 88% of the gains came from the top 10 stocks. So it's been a very narrow rally here so far. But from a technical perspective, this has been very interesting because we climbed up very rapidly last week. We got above the 200-week moving average, then we moved above the 200-day moving average, then we crossed above the 50. And as soon as we did that, the market just took off and we ran into the top of this downtrend line from really the April highs. And that was a kind of our initial target. And the market climbed above that a little bit on Monday. And then on Tuesday and Wednesday and Thursday, we came back down and are retesting that level of support. So we're now turning that previous resistance, that downtrend line that we got above it, turning that into support if the market can hold through Thursday. So that's the big ish. But right now, the markets are positive today. Started out a little bit weak this morning because of the jobless claims data. But the market has really kind of looked at that and now taken off again. And we're seeing technology back into kind of leading the charge. Google, Apple, Microsoft really kind of running the boat today. But importantly, when we kind of looked at some of the longer term trends of the markets and in the newsletter, we got through this kind of issues of the different factors that are weighing on the economy and the markets, and this kind of dichotomy we have between this rising bull market that we've got going on and the issues of kind of the underlying indicators. But what was important last week, and we said this in the letter, if this lower left-hand quadrant of this 6-panel chart that I'm showing you is important. So this is every major market and sector. So this is international emerging markets. It is all the sectors of the S&P and bonds all kind of put into one chart. And what we measure is every week. So this is a weekly adjustment. We measure how much those sectors or markets are overbought. And last week, every one of those sectors and markets were massively overbought. I mean,
that's amazing.
Yeah, they were just pegged at the top. So we wrote in there, said, be aware that we're likely going to have a correction this coming week. And that's exactly what's happened so far. So
sorry to interrupt, but just to use another Spinal Tap analogy, I mean, it looks like they're all pegged to 11.
They are for the most part, other than bonds, and which is now caught up this week because bonds had a pretty good week this week. But it's been a very interesting market this year, because last year it was up like 30%. Else was negative, and everybody hated FANG stocks. So in November, I wrote this article called "Are FANG Stocks Dead?" And it gave basically saying, look, everybody hates FANG stocks. It's probably time to buy FANG stocks. And if you'll notice, this year, technology, communications, and discretionary are the 3 best performing sectors by a wide margin over what over what the major market's doing. But energy is one of the worst performing sectors. So it's just kind of a very interesting rotation now occurring within the overall markets.
Hey, can I ask a question about that?
Yeah.
Is it rotation, or is this more just sort of overall net market inflows and outflows, right? You had that chart earlier that said that 88% of the gains so far this year have come from those top stocks, right? And this is sort of that giant mindless robot we talk about that Bill Fleckenstein and Michael Green talk about, the algorithmic. Yeah. Is that more what's been going on here, which is just that more capital has been coming in? We talked about liquidity indices last week that were rising since October.
Yeah, so it's a little bit of that. So a little bit of it is, actually, let me rephrase it. A lot of it is the passive indexing issue, which is, Apple's in 383 or 85 different ETFs. And so every time somebody buys the S&P-Y, the SPY, S&P 500 ETF, or they buy the Vanguard S&P 500 ETF, or they buy a mega cap growth stock ETF, Apple's in all those. So so out of all the money flows that are coming in, the top 10 stocks make up about 30% of the index. So they get 30% of the flow. So not surprising that's the case. But also it is important that money is coming out of areas like energy and the other kind of inflationary assets from last year are now moving into the disinflationary assets this year. So the rotation is really pretty clear that the inflation trades of last year are now becoming disinflation trades. And you and I talked about this. We said, look, when we get to that disinflationary environment, money's going to go to companies that can generate earnings in a slower growth economy, and that's technology. So, that's exactly what you're seeing going on here. And there's one other quick chart here. Let me just show you this one very quickly, because I think this really sums up a couple of important points. So this is what we call our risk reward analysis. And this is in our newsletter every week. And what this table shows us is on the right hand. So this is what this does is this resets on the first day of every month. So on the first day of every month, everything is trading within its normal range for a month. So in a normal month, and this is based on volatility of each individual sector or market. So basic materials, for example, might move up or down in a given month by 2%, right? On average, I'm just making up a number. So if it moves more than that in a month, it's outside of its normal volatility ranges. And that suggests that if it's up more than 2% or down more than 2%, that there may be an opportunity to buy or sell in that if it's outside of its normal ranges. And so what we're seeing here is, and again, this will be updated this week, and we'll see what the ranges are for the month of April so far. But we're probably going to see technology trading outside of its normal range because of what it's been doing as of late. But I want you to really but focus on this far right-hand side, which is the deviation above the short and long-term moving averages. So this is the deviation of these individual sectors and markets above and below their long-term moving averages. And then the far right-hand column where it says bullish or bearish, that is when the short-term weekly moving average has crossed above or below the long-term moving average. So this basically think about like a 50-day, 200-day moving average, but this is on a much longer weekly basis. So it's a slower to turn and gives you a much better signal of market trends. What's interesting is that despite all of the bearishness in the overall view of the market, the vast majority of sectors and markets are in bullish trends. In other words, the short-term moving averages have now crossed above long-term moving averages.
Yep.
And those tend to stay in place for 12 to 18 months. So what this tells you is that the market itself, in terms of price action, is a lot more bullish than what the economic headlines and kind of media is telling us. And so we want to make sure and give some credence to that. Doesn't mean it can't rotate over and go very bearish quickly. We did see that back in 2015, 2016 during Brexit. We had turned everything bullish, quickly went bearish. Janet Yellen calls the Bank of England, says, y'all need to do QE. And then 3 weeks later, everything was back to bullish again. So, these can flip-flop back and forth, but normally outside of extraordinary events, these tend to be more bullish, longer-term indicators.
All right, that's super fascinating, Lance. I'm really curious. What did it look like last October when we were near the lows?
Oh, well, that's a really good question because, back then, everything was super bearish at that point, of course, and everybody was very concerned, like, this is, really kind of the depths of the bear market. And so let's go back and we can look at that exact same chart. I keep this chart consistent every week, and I store it in a folder. So I can actually go back eight years now and look at these charts from 5, 6, 7 years ago. And it's always interesting to do these kind of comparative analysis. But this is the actual chart. Whoops, hold on. So this is the actual chart from October of last year. And you'll see that basically every sector and market is in bearish territory. But now notice, though, the risk range, which is, it says risk range high. And you'll see all those red bars versus green bars. That means that those sectors or markets were trading outside of their normal risk ranges. At that time, only real estate and utilities were trading within their normal risk ranges that were kind of set up in a more bullish sector. And back then, it was interesting because utilities were in a bullish mode, which you would expect during a bear market. And today now they're now one of the few sectors that are bearish because of the rotation out of those sectors of safety back into risk in the markets. So yeah, it's a different view.
Awesome. Hey, do me a favor, just pull up the newsletter again real quickly while we're talking here. But I'm glad that you've walked through all this, Lance, because it really does give a lot of insight into exactly how technical the analysis that you guys do at RIA is, right? It's not just guys with opinions. You're looking at a ton of data, and then you're processing that, and then you're, arguing back and forth with your colleague there, Michael Leibowitz, and, trying to come up with, a course of action based upon what all the data is telling us. But if you can pull up the newsletter you were walking through and share your screen again real quick.
Sure. Okay.
So just scroll up and down for a second, just so people can get a sense for, all the different types of charts and data that you have in there. You guys put this out every weekend. Correct? So if somebody wants to get a good dashboard on what all the major indices are saying and the key, data sets that you guys are looking at right now to base on your decision making, they can actually subscribe to this newsletter for free and get all this, right?
Absolutely. Yeah, absolutely. No risk at all. And we go through, so every week we kind of go, like I said, this week's topic, right? We have a topic that we go through. We start out with just a market view, and we say, this is what happened in the markets this week. This is what we expect next week. And then we have a topic. So this week is reverse repo. What does it mean? What does that mean for banks? What's happening with it? Is this something to be concerned about, right? There's lots of concern about it. But once we get down towards the bottom, we go through a lot of just market analysis. So market statistics. We look at every individual sector, which sectors are performing best and worst. We look at the overall S&P 500. We break that down into sectors. We look at valuations, market trends, all this type of stuff, looking at relative performance. I showed you this chart a second ago. We also run a weekly technical composite that tells you if the market's overbought or oversold on a week. This is a composite of about 15 different technical indicators. is the market grossly overbought or oversold? We have our own proprietary greed fear index. The complaint I have with the CNN fear greed index, I'm not saying it's wrong. Just the complaint I have with it is that it uses the S&P to measure the S&P. Our greed fear index is looking at how investors are allocated to the markets to determine if they're being greedy or fearful. So as a relative measure of the S&P, looking at the S&P, how are we positioned? Are we overexposed to equities or underexposed to equities? So I think it gives us a better signal about overbought, oversold, fear conditions in the markets. Again, the risk range report. And then we also provide stock screens every week. So if you're looking for stock ideas, we provide those in the newsletter as well for you. And again, it's all free. And of course, all the trades that we do in our portfolios.
Okay, great. And again, people can A, get this for free. B, they don't need to be working with you guys as clients, right? Just anybody can get this, right?
Right. Yeah. So just go to the website, realinvestmentadvice.com, and there's a link on the.
Can A, get this for free. B, they don't need to be working with you guys as clients, right? Just anybody can get this, right?
Right. Yeah. So just go to the website, realinvestmentadvice.com, and there's a link on the front page that says subscribe to the newsletter. We also produce a daily market commentary that goes out every morning at 7:30. So if you want like a daily update, what we're thinking about the markets today, that's free also. And we post 3 blogs a week, which are free. So, there's just a ton of free stuff at the website to help you manage your money better.
All right, great. So to bring in yet another iconic band analogy, if you want more cowbell, you want more Lance Roberts,
exactly.
Go follow those instructions.
If you don't get enough here, you can
exactly.
Go more at the website.
If the hour and a half plus that you get from Lance here every week isn't enough for you, you can gorge yourself over at realinvestmentadvice.com. All right, look, lots more to ask you, but because you brought it up, can you just talk for a moment about what's going on in the reverse repo market and if folks should be paying attention to it?
Yeah, it's kind of like the dollar devaluation or de-dollarization issue lately. Everybody's like, oh my gosh, it was on Tucker Carlson did a whole segment last night on Fox Business on dollar de-dollarization. And, it's like, look, is it an issue? Yes, not in our lifetimes. It's going to be a very long time. You and I spoke about this a couple of weeks ago.
It's like a rising sea levels type of thing where it may happen, but they're not going to jump by 10 feet tomorrow. Yeah.
Right. And so just calm, as my wife always says, calm your so, just calm down.
Oh, come on. You're making me having to edit that now, brother.
All right. Just calm down. It's fine. Anyway, but no, reverse repo is kind of interesting. So, there's a couple of, a lot of conversation lately about what's happening in the reverse repo market and what is that? Reverse repo is a program by the Federal Reserve, and it's reverse repurchase agreements. And that's what it is. It's basically, I'm the Federal Reserve and Adam is a bank, as an example. It can also be a mutual fund. It can also be an investment bank. Anybody that has access to the Fed window, right? They can take advantage of this program. It's basically an overnight agreement. As a Fed, I sell securities to Adam, and Adam says, great, I'll buy that security from you at X price. And so we agree on a price, whatever that is. Tomorrow, the Federal Reserve says, okay, I'm now going to repurchase. This is what's called reverse repo. So reverse repurchase. Because now the Fed says, oh, Adam, I'm going to buy that back from you. And we have an agreed to price that's higher than what I sold it to you to start with. And the differential is basically the interest rate. So there is no Fed funds rate, right? So when the Fed talks about the Fed funds rate, they always talk about the Fed fund target rate. That's their target. I would like, the interest rate at 4.75%. If you go to download the effective Fed funds rate data from the Federal Reserve, from the St. Louis Fed, sorry, you can actually chart it, and it moves up and down, but it's not the smooth lines of just here, this was the Fed meeting, and then here's the next Fed meeting. This thing moves up and down, and that's because the market is working around that target rate. The real rate is adjusting daily. It might be half a basis point higher or lower than what the target rate might be, and that's being adjusted by this reverse repurchase program. That's what the Fed uses to kind of keep that Fed funds rate around their target. And so this is what's happening in the overall market. Now, all of a sudden,
right. And sorry to interrupt, but when they talk about the Fed's fund rate, the Fed, they actually give it as a range.
That's
right?
correct.
It's like a 25 basis point range. They don't actually give it an actual percentage. They say it's from here to here.
Correct. And that's why, because there isn't a Fed funds rate. It's a target rate, an area they would like it to be. And so that's how they manage what happens with bank liquidity, et cetera. So what's interesting is, and what's attention is, there's $2.5 sitting in this reverse repo program. So there's a whole bunch of money sitting over here. Now, what's going on with that? Well,
sorry, Lance, I think you glitched there for a second. Can you repeat that number again?
Okay, so there's roughly like $2.3 to $2.5 trillion sitting over here in this reverse repo program. And of course, this has gotten everybody's attention because, what was it like back in 2008 during the financial crisis? Surely that was a massive number. No, it was like 300 million. I mean, it was very small. In fact, you go look at the pandemic, it barely even shows up on the chart. So this program has really gone out, and what this is due to is all this liquidity that we pumped into the system back in 2020, 2021, and that's where really this program really started to take off, was when all that liquidity, quantitative easing, and of course all the fiscal programs were dumped in. We sent cash to households. What did they do with it? Well, they put it in their bank, right? So there's all these extra bank savings that are now in this being used through this repurchase program. And so there's two things about this. One is that this is part of the issue that's putting stress on banks, because and I'm not talking about the big banks, I'm talking about small to mid-sized banks. I was doing the radio show this morning, and on CNBC, they had a chart up on CNBC of the different interest rates. It was a commercial for Interactive Brokers, and they had a chart of the different interest rates that banks were providing. Schwab's like 0.1%, JP Morgan's like 0.01%. Nobody's paying you any money on money markets, and Interactive Brokers going, hey, put your money with us. We're paying 4.5%. That's what Fidelity will pay you on a money market fund. Mm-hmm. So money market funds are paying 4.25%, much more than what banks are. But banks are storing all this money in reverse repo, and they're getting 4.5% from the Fed and paying you squat. So,
and I have ranted about this a lot on this program.
Yeah, but the reason is twofold. One, the banks don't really want your deposits, first of all, because they've got a problem. They've got nowhere to lend it. If you take a look at what's going on right now with delinquency rates in credit cards and auto loans, those are surging up. Tightening lending standards in the sub 100 market cap banks are all getting markedly tighter on credit cards, auto loans, home loans, commercial real estate loans, because they're now worried if, taking that risk. If I'm the bank, do I really want to loan Adam money for a car or for a house or for a commercial business in this environment? I'm not sure he's going to make it. I'm not sure he's going to pay me back. So I'm really starting to pull back from that lending. So that only leaves me really one place to store the money right now, because right. Because most importantly, I also need the collateral. Again, what happened to Silicon Valley Bank was a problem. They didn't do anything really wrong. Their collateral had gotten depressed in price because of rising interest rates. And all of a sudden they had a massive run on the bank. They had $40 billion evaporate overnight.
Well, they didn't hedge against that rising rate expertise. So their risk management was wrong. But yes, they were buying quote unquote safe, assets that just the duration burned them in this sort of, yeah. Can I just ask a question about that for a second? So look, to a certain extent, you're like, why wouldn't banks do this, right? Like I've talked about this with Nick Jurley about housing market investing, right? Where like now, because of these much safer alternatives, it's like in the way in which housing rental returns are all of a sudden not nearly as positive as they were. It's like, why take on all the risk? If I've got this excess capital, why take on all this excess risk that's currently in the housing market and just in general with being a landlord and whatnot? And why not just put that money into something that's paying me like 4.8%, right? That's totally safe, right? So a lot of people are deciding I'm not going to buy that rental building anymore, and I'm now going to just park it in treasuries, right? the bank is making the same decision. Like, why lend to these people who are kind of riskier and the market environment's getting more risky? Let me just go to the Fed and get this. Like, I totally get why they're doing that. These are kind of like perverted incentives because obviously banks are there to lend and support the local economy. But we gave them all this money. They're now getting a bunch of kind of free profit off of it, right? And they're not fulfilling their function in the community anymore, or at least not as much as they were, right? So, I mean, I have a hard time, like, I do get a little angry thinking about this, which is like, they're getting all this free money. And to your point, they're not, at a minimum, they're not sharing it with their depositors, right?
Right. Well, see, and then this was I was just about to say is that, see, the banks have a problem. So the problem for the banks is now, again, when I talk about the banks in this kind of conversation, you can just take JP Morgan, Bank of America, Wells Fargo, take the top 5 banks, just set them off on the side. They are not banks. They are kind of a different breed of thing in this environment. But for the regional, mid-sized banks to small banks. Remember, most of these banks are just your community banker. Their whole platform is, I make money by you depositing money with me. I then loan that money out and to a business or a person or whatever it is for a period of time. And I do need to keep some reserves in-house because I have these demand deposits. A demand deposit is basically money on demand, checking account, savings account. Adam can show up any day and say, I want all my money out of the bank. I'm going to go buy a boat, right? And so I've got to be able to redeem that. So I've got to keep some assets over here in liquid collateral. And I do that by buying bonds. And this is what I was just about to say with Silicon Valley Bank, is that they had collateral sitting over there. And so when these deposits came in, the problem was they had to sell all their collateral at a deep discount because interest rates gone up and their collateral values had gone down. Well, banks have two, when you look at a bank balance sheet, they have 2 pots of their securities that they're holding. They have one pot over here that's normally a very small sliver that's hold to maturity bonds. So they have these bonds as collateral that they're going to hold till maturity. And these are maybe 10-year treasuries, whatever it is. Then they have the much bigger pot, which is auctionable securities. These are securities that they can sell at any time to meet demand withdrawals. So if you show up, and of course they've got cash on hand, but let's say you show up and you need $1 million and they've got $500,000 on hand, they'll go sell $500,000 worth of these bonds that are tradable, sellable at market value. So as long as interest rates haven't gone up, they've got plenty of room to work with. And what's interesting is if you look at that, I've actually got this chart in the newsletter this weekend if you want to see it. It's very fascinating that over the last year, as the Fed's been hiking rates, you can see this balloon. So in the total balances of this collateral that banks are holding, that little sliver down there that was hold to maturity has now become a very small mountain. And so all of a sudden they're having to go, okay, well, that bond, it's now hold to maturity. Oh, that bond, it's now hold to maturity. So their collateral that they have available for sale is shrinking rapidly. So that is making them a much more risk averse to making loans. So here's the problem for the Fed. The Fed could effectively get rid of that reverse repo by lowering the rate that they would pay to the banks on that overnight repurchase. So they could make it less attractive, right? So, well, and then theoretically, what would banks do? Banks would supposedly take that capital, instead of putting it into reverse repo, they'd go lend it out. But I don't want to. I don't like those. There's no good opportunities to loan it out right now. And more importantly, it doesn't work to the Fed's benefit, because if I put that money back into the system and bank loans, what do I create? Inflation. So the last thing the Fed wants to do is pull that reverse repo out all of a sudden and put it back into the economy and create inflation. So it's a really interesting situation, because on one side, you've got banks that are theoretically under stress because of higher interest rates, lower collateral values. The Fed can't get that money back into the banks, and money markets don't share with banks. So that doesn't work well for small banks either. But the Fed can't get that money out of reverse repo back into the banks to loan, because they'll create inflation. So it's an interesting standoff.
Boy, that is really interesting. So a couple quick things. One, this money is these reverse repos. That's a guaranteed win guaranteed win bet for the bank, right?
Yeah.
It's
absolutely.
like a nightly hand of blackjack that they know they're going to win, right? So they
it's not even a bet. It's me coming to you, Adam, and I say, I'm going to sell you this bond for $1. I'm going to buy it back tomorrow for $1.10. You good with that? And you say,
right,
yeah.
Right. I'm going to say, yeah, the bet is that the Fed is actually going to pay them what they say that is. And of course, it's the Fed. It will, right? So they know they're going to get this free money. What's so interesting is the Fed is using money, right? Using free money to banks to keep money out of the economy because it wants to destroy demand. Right. And that's what Powell's talking about. It's so interesting, right? It's like, how do you destroy demand? Oh, you give free money. It's that seems strange, but you've done a good job of explaining it. Yeah. So let me just recap what you've said then to the question of should folks worry about this? You're basically saying, no, the spike in reverse repo, it's not a sign of banks all of a sudden being really weak and having to really lean on the Fed for life support here. They're actually just taking the best bet they can find in this market right now. Rather than lend it out, I'm just going to get free money from the Fed at this rate.
Yeah, and the Fed's using this to try to sop up a lot of that excess money that we injected into the system back in 2020, 2021. So the Fed,
but to be clear though, it's not really sopping it up. It's because it still exists. It's giving it back to the banks every day. It's just keeping it in this limbo state, right?
Exactly. It's keeping it out of the economy is what it's not getting lent through the economy. So it's just keeping it out of the economy. So, so both parties are kind of benefiting from this bit of cushion that's sitting over here. Because, and if we look back also at, at money, M2 as a function of money supply, and this goes back to the issue of quantitative easing. This is one of the arguments that I got when I was writing this article. Is like, oh, well, that's just the Fed because all this quantitative easing that they put in, they're now getting quantitative easing back out in a different way other than doing QT. And that's not really true, right? Because back in 2008, we did a bunch of quantitative easing and money supply, M2, didn't rise that much. It rose a little, but not a lot. We've had a massive spike in M2 in 2020, 2021, because we sent checks directly to households, far different versus an asset swap with banks. This was money into households that went where? Right into banks. So it's savings, right? So I got a check. What do you do with the check? You put it in the bank. And what the bank have to do with it? The bank had to do something with it. So that's the whole cycle. A
lot of people bought cars and boats too, but yes, a chunk of that.
It went through the bank. It got in there. But that's what I'm saying is like this big surge in this repo program is sopping up a lot of that excess money that's still sitting in savings.
Okay. Wow, I could keep talking about this for a while because I understand why the Fed doesn't want it going into the economy and stoking inflation right now, like you said. Part of me feels like I'd almost rather have the Fed deal with this by sort of mandating that banks have to pay higher deposit rates, because that would reward in a behavior that would really benefit everybody, which would be people saving more, right? That money's still not necessarily going out in the economy.
But see, that's not good for the banks either. See, JP Morgan, why does JP Morgan pay 1%, 0.01% on their money market? They don't really want your deposit because, again, you deposit money, what do I have to do with it? I've either got to loan it out or I've got to go buy bonds with it, right? And neither one of those are advantageous. So,
right. Well, they also have the benefit too, though, of like, well, you're going to put your money with us anyways because you know we're safe. So I don't have to. If I don't have to pay you and you still give me your money, that's great, right?
That's even better. Yeah. And there's been like $300 billion that's transferred now out of small banks into big banks. Just
I know, which I just think is again perverse.
But it is. But also keep it in perspective. It's $300 billion on 17 trillion in deposits. Right. So it's a very small fraction. But
it's not nothing, right? It's a lot to those banks that are losing it. Right. Yeah, exactly. All right, great. So if there's nothing else on repo that's worth flagging for folks besides go read your article when it comes out this weekend, I have a ton of data that we haven't gotten into yet, and I know we're a bit pressed for time here, so I'm gonna soldier through if that's okay.
You go ahead.
All right, so yields have been marching down. Bond yields have been marching down pretty dramatically. So over the past week, the 10-year has gone from 3.6 down to 3.2%. Over the past month, it's gone from 4.1 down to 3.2%. That's a pretty big deal, isn't it? I mean, for bonds to move that much that quickly.
Yeah. So, recap, we bought bonds prior to the FOMC meeting and just prior to the Silicon Valley Bank blowout. We just bought more bonds this week because you now have a very confirmed technical breakout on the 10-year Treasury that now looks like we're going to see a pretty decent advance in bonds. This is all a good indicator that the economic weakness that we've been talking about for a while is starting to actually show up in the economy now. So
okay. Sorry, but just to be clear, because this is important, you think yields are more likely to continue going down from here?
Oh, absolutely. Yeah, absolutely. If we have a recession, yields are going to 1%. So
right. I'm going to ask you a question I just asked you last week, but I now got to ask you again. Did we miss the window to go long duration?
I am actually writing an article that'll be out on the website on Tuesday called Treasury Bonds, It's Time. So now have a very well-defined bottom in Treasury bonds. The top of interest rates is now in. You have not missed the trip yet. I would look, interest rates aren't going to go straight down either. Rates are going to tick back up. We'll probably see, I won't be surprised if we see a 3.5 or a 3.6 handle sometime in the next, couple of months. It could very well happen. And
you will see that as a buying opportunity.
Oh yeah. Anything that puts rates back up towards 3.5%, I'd be a buyer.
Okay. That's really important to know. I just also want to note too, while those rates are coming down on the longer duration treasuries, we haven't seen much movement yet on the short end, which maybe we wouldn't expect to see it if it's more concerns that are driving this. So like the 3-year and 6-year are still yielding 4.8% right now.
Right. And they should, because that's where the Fed is trading. Right. So the 3-month, so just to recap, I know we've said this about 1 billion times before, so I apologize, but just to recap for everybody, what drives the short end of the yield curve? So what is the yield curve? Yield curve is when you take a look at, like if you took a piece of graph paper and said, okay, what's the yield on the 3-month, the 6-month, the 1 year, the 2 year, the 5 year, the 10, 30 year, and you drew a line, it would make a nice little kind of a sloping curve on a piece of graph paper. So that's the yield curve.
Right. And sorry, but just want to let folks know, generally, yields go up the further out in time you go. And that's to compensate you for the time value of money and the risk involved in having someone have your money for a longer period of time.
Absolutely. That's a great point. But what affects those yields, and again, to your point, what affects those yields on the short end of the curve, so the 3-month, the 6-month, the 1 year, the 2 year, those have a super high correlation to the Fed funds rate. So whatever's happening on the short end of the curve is generally approximation of what is happening with the Federal Reserve Fed funds rate. So those are very, very close in terms of proximity. So the only thing the Fed can control is that short end of the curve. And that's your variable rate credit cards, that's your auto loans, that's those type of debt instruments on that end, very short-term debt. Once you move out on the curve, that is economic growth, inflation, and wages. That's what drives the long end. And that's where, once you get to 10-year, 20-year, 30-year bonds, that's your mortgages, that's your longer duration corporate loans, those type of things. That's on the long end. And if you think about it, if I'm going to loan Adam money for 10 years, I don't really care about what the Fed's doing right now with interest rates. I want to know if Adam's going to pay me back in 10 years. That's the real question. So I look at Adam's credit quality, right? And everybody knows Adam, probably won't pay his bills. So, in that environment, I'm going to charge Adam a whole lot more.
I'm always the deadbeat in your example.
I know. Well, you're always, moving around, can't get a backdrop put together.
Fair point.
Yeah. So, but the point is that there's the factors I look at for Adam on a long term is what's the economy going to be like 10 years from now? What's inflation going to be like 10 years from now? And I've got to make those estimates because I don't get to come back and tell Adam in 6 months, oh yeah, I didn't like that interest rate. Inflation's gone up. I'm gonna need to raise your interest rate. I don't get that choice because those are fixed payments over that 30-year period or 20-year period or 10-year period, whatever it is. So I've got to be pretty good in my estimates and then adjust for that risk of me being wrong and adjust for the risk of him being a good payer of his debt. So there's a lot of factors that go in that long end curve, but those are all economically and risk centric. And so that's why you're seeing those interest rates on the long end come down, because now people are picking up on this idea that, oh, wait a second, the economy is not as strong as I think. That's going to be the risk that, I'm going to have to deal with. And so we're starting to see that idea that slower economic growth out there on the long end of the curve, I don't really want to be out there. And so that's starting to drop those yields on the long end.
Okay. All right. Great explanation. Thank you. And well, let me go back to my question for a second. So, we would expect to see the Fed dictate the action on the short end.
Right.
But also when people are getting worried about a near-term crisis, what we tend to see in the yield curve is an inversion. Right. And that's what we have been seeing. In fact, almost every yield curve is inverted right now. But you were basically saying that you think the activity that we're seeing right now in yields on the longer end of the curve is suggestive that the chickens people are thinking the chickens are maybe now on their way to coming home to roost, correct?
Yeah, absolutely. Look, we talked about this before, and I actually, have written about this a couple of times. I don't know how we don't have a recession. Honestly, you take a look at the ISM data, you take a look at the leading economic indicator data, you take a look at the economic composite in data. All the data says we're going to have a recession. The Fed's hiking rates to slow the economy. If you're going to slow the economy, you're going to have a recession. That's just kind of part and parcel of how all this works. And that's how you get rid of inflation. So the Fed wants a recession. They may not say that, but that's what they want. The data says we're going to have a recession. ISM services yesterday at 51. That's still an expansion, but down from 55 and much lower than the 54 expectations. And the internal components were terrible.
Right. And the manufacturing section was even worse. And we'll talk about that in a minute. Yeah.
ISM manufacturing is deeply in contractionary territory. But again, the thing we want to understand though also is that services now make up 80% of our economy. Manufacturing is only 20%. That was inverted back in the 70s. So manufacturing used to have a lot bigger driver on the economy than it does today. Services is very important. It also has a lower multiplier effect, which is why the economy doesn't grow as fast anymore either. But another conversation for another day.
Yep.
But like I said, I don't know how we get around not having a recession yet. Economists are raising their economic growth rates for this year. S&P is raising their earnings estimates for this year. The markets are doing well since October, suggesting that there's no recession on the horizon. I don't know who's going to be right. I tend to want to lean towards the economic fundamentals, but we have to make room for something being different this time.
All right, this is a great transition to what I want to get into next, but real quick, I think I might have asked you this question before, but I want to ask it again. So there's a very big disconnect right now between what the market thinks is going to happen and what sort of history and math, tell us is going to happen. In terms of this disconnect, how big is it relative to other disconnects you've seen in your career?
This is one of the larger ones. I don't remember a period in time where the market was this disconnected from the underlying economic fundamentals, but there's also a difference this time. And I hate saying that because we all know what saying it's different this time is, but this time really is different because as you and I talked about before, the big difference is that we've been training the markets for a decade now to just respond to the Fed. We don't even really, while we look at the employment data, the market really doesn't care about the employment data. They just want to know what it means to what the Fed's going to do next. So, tomorrow we'll have the employment data come out, and the first blush of headlines is going to be either it was stronger than expected or weaker than expected. What does that mean for the Fed at the upcoming meeting? Right. Then that's the difference that we've got to deal with this time around.
Right. I would say maybe the other difference this time around too is the fact that we shoved an awfully big pig into the economy python, and we still don't know really how much of it is left. And I read a headline the other day that suggested that there was still like $1 trillion in excess savings still kind of sloshing around. And
it's a lot.
And if that's true, it just means it can distort a lot of natural market forces for longer than many of us can imagine. I don't know if it's true or not, but to your point about, all that really matters to the market is what it thinks the Fed's going to do. Great segue. So the Fed was surprised earlier this week, along with the rest of the world, by a production cut at OPEC for oil production. Right. That is inflationary, right? Price of oil jumped on that. A lot of discussion here that this may be just sort of the start and that oil might start creeping back up here again. The Fed, with Bullard being the sort of the spokesperson for this week, said, hey, caught us by surprise. It's inflationary. he just did an interview with Bloomberg, which, basically said, hey, look, we've got the tools to use if we need to. And my sort of interpretation of that was saying, look, we're going to continue to fight inflation. And if we end up over tightening and going too far, we know how to undo that, right? We know how to turn on the monetary floodgates. We know how to do stimulus. And he reiterated that he thinks the Fed is going to need to go over 5% on the Fed funds rate. And when pressed, he said, well, my latest read is that kind of the committee here at the Fed thinks that it's going to need to go a little over 5%. And he said, I think it's going to need to be a little more than that. So he's kind of erring on the high side here, right? So the point is a lot of people think that Powell is going to pause next. And he very well may. I just did an interview with Bill Fleckenstein, who thinks the Fed's going to pause here and then hold it for the rest of the year. So he doesn't think the Fed's going to hike anymore. You and I had been talking about the wisdom of the Fed pausing, and probably should have paused a while ago, because we've talked all about the lag effects and waiting to see what happens there. But my point is the market that seems so incredibly confident that the Fed is going to pivot really soon, the Fed just got another reason why it needs to be steadfast right now against inflation with this oil production cut, right? And the Fed is still talking, Powell from a couple of weeks ago, Bullard this week, of no. Like pivoting is not on our radar at all right now. Bullard's still talking hikes. And it does seem from a lot of people's standpoint that Powell is going to literally pause unless he is forced from here. So here's my question for you, which is, at best we can hope for a pause. And just want to note too that in recent weeks, Bank of Canada's paused. The Australian central bank has paused. Today it was announced that the Indian central bank has paused. So we may very well follow suit and pause, but a pause is not a pivot. It still keeps rates really high. There's a chart that the Fed, that Zero Hedge puts up a lot. It's a Bloomberg chart. I'll put it up here. But it shows that we're kind of at the greatest point of disconnect between the Fed's dot plot projections and where the market thinks interest rates are going to be going forward from here. So back to your point, Lance, like this is one of the bigger disconnects that I think we've seen here. If indeed the Fed stays the course and hikes or pauses and keeps it from here, especially if those recessionary forces that you think may be coming in force really do begin to appear. But it just seems that unless there's something we're missing here, the market likely or potentially has a pretty big repricing in front of it, right? Where it says, you know what, we were wrong. The Fed was not going to pivot and we've got to reprice that in. Or my God, we were believing the soft to no landing scenario and now it looks like it's going to be hard. But if history and math is right, it does look like there's a potential for a big downward repricing here, correct?
No, absolutely. So if you so going into the next FOMC meeting, I think right now, as of this morning, it was basically a 50-50 split between no hike and a 25 basis point hike. So, but what is interesting is to your point, the Fed is talking about, okay, either whether they hike at the next meeting or stay flat. What they're saying is we're going to stay there for a while. Even Loretta Mester this week, she flip-flopped in 2 days. She came out on Monday and she said, oh yeah, we're going to have to hike above 5% right now because of, inflation. That's still our main focus. And the financial banks, they look completely fine. So don't worry about that. The next day we had the ISM services index come out. She's like, well, maybe we're done hiking. So, very quickly there was a flip-flop there. But the point is simply this. Whether or not they hike or not, they're not going to be cutting anytime soon. But yet the market thinks the Fed's going to be cutting rates by June and we'll be down 110 basis points in the Fed funds rate by the end of the year. That's not what the Fed is saying, but that's what the markets are betting on. So to your point, if the economy does slow down and gets into a recession, yes, the Fed will probably start cutting rates. But the problem for the market is that their expectations of earnings estimates are still way too high. And now they're even higher because they upped those estimates into 2024 back to where we were in January of 22. So all that's got to come down, which means you have to reprice equities lower at some point for that. And valuations are still too high for slower economic growth. So you've got the market's got a problem ahead of them. And if the Fed doesn't cut, you're going to have, a bigger problem as well. So, I mean, it's just no matter, where the market goes. This is what I was saying earlier. I don't know how you don't have another leg. Again, when I say this, don't go running off thinking I'm talking about a 50%, fall off in the market. You're going to have some repricing to adjust for lower earnings, which means the market is going to have to come down some more. But that might be 10%, it might be 20%. But whatever gets that valuation back in line, between the P and the E, right? That's what gets your valuations. So to get those valuations down, prices will have to come down to adjust for lower earnings, but you got to know where those earnings are going to wind up first.
Yeah, so we're about to be going into earnings season, right? As we just finished Q1. So, obviously, whatever the earnings are is going to be important, but what's going to be really important, obviously, is going to be the forward guidance that these companies offer, right?
Yeah, absolutely. Look, what they report, don't even worry about that. They're going to say, oh, we beat estimates by a penny or missed by a penny, or whatever.
That's the game.
And as I tell you every time we do this, it's millennial earnings season, right? We lower the bar, everybody gets a trophy, and so we all go on. What's going to be important is what they say about the next couple of quarters. If their views aren't, oh, we're seeing consumers come back to spend money. Oh, our inventories are in line to where we want, our supply chains are full, whatever. If they're not coming out with fairly good guidance, I think there's some repricing risk to the downside.
So I was going to ask, besides a crack addiction, what has caused analysts to raise their forward earnings recently? But maybe it is just a continuation of the game, right? Where it's Wall Street just saying, hey, we're setting next year's limbo bar now, and just like GDP quarterly estimates, it's probably going to walk down all through the quarter, and by the time we step over it at the end, everybody is going to be able to, because we started high, and then we can all say, oh, we beat at the end.
No, that's exactly it. And this is why it's, every time you look at the beat rates, right? Everybody's talking about, oh, we had 70% of companies beat earnings and 80% of companies beat earnings. And it's all nonsense, because first of all, they're beating operating earnings, which are earnings without all the bad stuff in it. If you actually reported GAAP earnings, they probably wouldn't be beating that much. But secondly is because we don't hold analysts to their estimates. If we actually held analysts to that, say, okay, Adam, you're the analyst, you get what's Apple going to earn this quarter, and you say it's going to earn $1.50. Okay, you're in. That's your bet for the quarter. You can't change it. The problem is that, yeah, you're absolutely right. I'm going to do a Fox Business interview with Ed Giardini here right after we finish up our conversation today. And, he's very bullish on earnings. He's like, oh yeah, earnings estimates are super high. Well, it's great to be bullish, right? And it's great to be optimistic, because nobody remembers that you said earnings were going to be here, and then you said earnings were going to be here, and then you said earnings were going to be here, and then everybody beat earnings that you said were down here. Nobody remembers all those revisions to the downside. They just remember that everybody beat what you said they were going to beat.
Right.
But that's the way the market works. And so being bullish and optimistic is always much more fun side of the ledger to be on. It sucks to be a bear. Nobody wants to hang out with boring people, right? So be bullish. Everybody wants to hang out with you. But the point is that we have to be rational about this and understand what we're paying for. And this is the big risk to earnings estimates. If you look at earnings estimates, they say, great, based on the current price and estimates for earnings at the end of next year, valuations are 17 times earnings. And that's the historical fair valuation going back to 2000. Great. So buy stocks, right? Not necessarily, because if you buy those stocks today at 17 times earnings, if earnings aren't what they said they were going to be a year from now, and assuming that prices don't even move, right, you will have overpaid for those earnings that you thought you were going to get by a large degree. And again, price is going to move. And if those estimates come down and you're overpaying today, the price of what you bought is going to come down as well. That's just the math of valuations and how it works.
Okay. Hey, just because I said it, I want to put up a chart real quickly here of GDP now from Q1. So this is the Atlanta Fed's kind of real-time GDP tracker. And it was pretty darn robust for the entire quarter. And it's kind of fallen off a cliff here. I actually don't have it in front of me, so I'm doing this from memory. You guys can look at the actual chart here and have the final numbers. But I think it was something like, I was predicting like 3.5% as recently as like 10 days ago.
Yep.
and it's Dow down maybe 1.7. I don't know. You guys can see on the chart what it is, but that's what my memory was sort of telling me.
Yeah, and that's right. And look, if you take a look at the Citigroup Surprise Index as a good example, so the Citigroup Surprise Index measures the economic data relative to the expectations. So all the economists expect, some economic data point to be X. It turns out to be Y, which was better than expected. Think about all those employment reports that we were talking about over the last few months, right? Coming in a lot stronger than expectations. All of a sudden, just like the Atlanta Fed, that surprise index is coming down. In other words, the analysts have gotten too optimistic, and now the actual economic data is coming in weaker than expected. So that surprise index is coming down. The Atlanta Fed, they just track those real-time data points. They always start out pretty high. And then as the real-time data comes in, it gets ratcheted down.
It tends to get lower, yeah.
Yeah. And that's what we're seeing now. I won't be surprised if that data is below 1% by the time we get to the end of the quarter.
All right. And I just checked it. Folks already saw this from the chart I put up. It was actually at 1.5 right now. Okay. Yeah. And you're saying maybe when all the data's in, it's even under 1%. But
right. And like the jobless claims data that we got on Thursday, the last 2 months, those jobless claims were revised up by more than 50,000 jobs. So, 50,000 claims. So now that data is coming in weaker now. The revisions are now weaker than even what we thought the data was.
Right. And we're going to talk about that jobless data in just a second here, because that's been one of the big flags we've been raising, is that we think this jobs data has been suspect for a long time, and we're beginning to see the crack in it. Real quick, just a couple other things that have been noteworthy and newsworthy this week. So one is that gold has actually done quite well since we last met. It punched through the 2,000 an ounce level, which is an important sort of psychological level, right? Humans like big round numbers, and when it closed 2 days ago, I think at like 2040, I saw a stat that said, like, I think it was only one of 5 times in history that gold had closed at that price. Or that price or higher, right? So this could be a new leg higher in precious metals. And just the point I want to make on it, we'll see. We'll be tracking it. We'll let you know. But it could be due to a number of things. One, that maybe the Fed is closer to a pause. I just rattled off all those other central banks that are pausing. It's not a pivot, but a pause is still probably interpreted as a step towards a pivot, and an asset like gold might react to that. It could be due to all these screaming headlines of de-dollarization that you've been talking about, Lance, right? People could just be saying, okay, fiat currency wars, we're just going to go hide in gold. Obviously, if oil is boosting inflation, maybe people are going into gold as a bit of an inflation hedge. Who knows? We're going to find out going forward. I do want to underscore for folks real quick, though, if you didn't see it, I did an interview earlier this week with Matthew Peipenberg. Honestly, folks, one of the best interviews I've ever done in the history of this channel so far. And Matt ends up concluding, as part of his sort of long arc of history and where he thinks things are heading, in saying, hey, he thinks gold's an important asset to own. And the analogy he used is just the one I want to share here with viewers, which is, he said he grew up playing competitive baseball. And he said we kind of knew at the beginning of a baseball game whether we were going to win or lose, because it really all came down to which team had the better pitcher, right? We could tell early on if the pitchers were imbalanced, that we sort of knew who was going to win the game. And yeah, we'd still go out, and he played third base. I'd go out to third base and I'd do what I needed to do, but we knew our pitcher was going to win or lose the game for us, pretty early on. And he says, when it comes to the fiat currencies, he says, look, you just look at the loss of purchasing power in every fiat currency over the course of the past several decades, past century, whatever. And you look at how gold has held its purchasing power, and he just says, look, I just see gold as a better pitcher currency wise. And so, if you're looking to just sort of store value in the future, and he's not saying all the fiat currencies are going to zero tomorrow or gold's going to $1 bazillion tomorrow. But I did like this better pitcher analogy for those that sort of take the long view. So Lance, anything you want to say about gold's move right now?
Yeah, pretty much everything you said is wrong. So first of all, gold is extremely overbought right now. So if you want to own gold, I don't have any problem with you owning it, but remember, it's a commodity.
Wait, I'm not sure where you stand on this issue, Lance. I'm sorry.
Yeah. So gold's had a great run here over the last couple of months. Since October lows, actually, the correlation to the stock market's extremely high. So if you look back over the last year in particular, as stocks were selling off, risk assets were selling off, gold sold off with it, gold bottomed in October along with the stock market. So you've actually had a much better return on equities than gold over the last several months. But nonetheless, it's now moved up. It's extremely overbought. So if you want to own it, that's fine. I don't have any problem with you buying gold, but you may want to wait a little bit here. You're normally, when you get this overbought, you're going to get a pullback in price just because of the technicals of how things work, right? So prices can only move in so far in one direction before they have to have a correction. Last time that we were this overbought was back in kind of early this year. And then we had that fairly decent correction that went in, I think, January, February, where gold sold off by about $100 an ounce or so. So again, you'll get a decent little pullback here to where, you'll be able to make a better entry point to make some money on. So just, be careful about where you enter this. Long-term gold has not held its purchasing power relative to something else. Peter Schiff did this analogy about buying a suit in gold. And if you bought a suit back in gold, today you could buy 40 suits in gold. If you took the same amount of money and stuck it in the S&P index, you could buy 3,000 suits for the same money. So, again, gold isn't an inflation hedge. We're no longer on a reserve currency basis where gold is backed or dollars are backed by any commodity. We're a fiat currency everywhere in the world. So, again, it's all about how you invest your money. In theory, it sounds great that if I buy gold, that it's going to hold value, but it really doesn't relative to other assets.
Well, yeah. So it was a store of value argument relative to other currencies,
right? And store value.
But you're talking about investing.
Well, no, the store value is, look, if you're putting it in gold, that's an investment. If I buy silver, that's an investment. I'm not storing my money there. I've converted my money into something else. So I can convert it to gold. I can convert it to silver, uranium. I can buy a house with it, store value there. I can put it in the stock market, store value there. It's all a store value. It's just a question of where you're putting it. And so the idea that putting it in gold, it makes me feel good because I can hold it, put it in a safe, whatever. I still got to convert it back to dollars if I want to spend it because we're not on a barter system. And I'm not saying that gold isn't a good investment. Don't take what I'm saying is wrong. Just some of these philosophies around it that people throw out there, they sound great in theory, but that's not how things really work economically. So again, it's all about managing risk. And it's all about getting the best return on your money over time. And so just put that in the context of where you invest. Should you own some gold? I have no problem with that. I own some gold. I have some, right? So I think you should too. But is it the best investment? That's the thing we want to know.
Yeah. And best return your wealth over time, I think, is it's the right North Star. It's why we have you financial advisors involved in this whole process. All right. I'd love to keep talking about that, but I'm like not even halfway through my sheet yet. And we got what? We got 20 minutes left.
You can go a little bit long today because I have 45 minutes till Fox.
Oh, okay. All right. So I just want to get your opinion on this. I'm not saying this is going to happen. I sure hope it does in the big picture. But I caught a headline today saying that Ukraine is potentially indicating that it's willing to concede Crimea to Russia. Yeah. I mean, Russia's already in it. I mean, it's whatever.
That's all they ever wanted. That's all Russia ever wanted was Crimea.
Yeah, well, it sounds like there are a few other eastern provinces that they want to hold on to too, right? Which Ukraine is not, to my knowledge, ready to give up on yet. But my point is if this is a sign of thawing, that like, okay, wait a minute, maybe we can start talking again and eventually get to some sort of negotiated peace settlement here. Let's all hope at the end of the day that, the fighting stops one way or another. I just raise it here to say, you mentioned that you're concerned about where all the macro data is showing we're likely headed this year and how the market's going to reprice and all that stuff. But what impact do you think a announcement of a negotiated peace settlement would have on markets here?
I think it'd be great, honestly, because a couple of things. First of all, this whole thing started out, originally with this Russian aggression. This was all about the Black Sea, is about their military base that Russia has, in Crimea right there on the Black Sea. And then, of course, there was a couple of other regions that you're talking about that were pretty pro-Russian anyway. They weren't really kind of in the mix of all this. And then this is all kind of, gotten way out of hand, probably more than it should have. Why we're bailing out and providing pensions and Social Security to Ukrainians, I'm not quite sure what that has to do with, the actual war effort. But we're spending, but we just sent another $2.8 billion, to Ukraine over this. And we spent, I think, a total now of closing in on $40 billion in terms of funding this war. Again, however you feel about Ukraine and all that has nothing to do with this. This is, economically speaking. But look, we're spending a lot of money that we've got to pay for at some point, which is, again, more debt leads to less economic growth over time because it's a diversion of assets that we have to pay interest payments on in order to repay that debt. And so we're helping a lot of other countries with their economic problems rather than our own economic problems that we have here. And we complain about these issues. So I think if you could alleviate that pressure, good news coming out of Ukraine would be excellent. That would certainly take one of the concerns off the market that has been laying out there for the last year, which is the potential of a World War III conflict. All of a sudden, Russia starts shooting off nuclear missiles, and everybody's we're back into World War III, and everybody's engaged. That's been one of the kind of the stories hanging in the background. It'd also be good for the dollar. It would also make the dollar a lot stronger if that happened as well.
Okay, so I'm just curious, and I'm just asking you to totally postulate here, so I'll hold you to it. But like,
that's all it is. It's all postulation.
What do you think the peace premium would be? Right? Does the market jump 10%? Does it jump 30%?
No, because if you remember when we got into this whole mess, the market only went down like 5% originally, and then the market rallied right after that. Right? So if they came out tomorrow and said, "Oh, we brokered a peace deal in Ukraine," and I would hope they would do that. If Joe Biden wants any chance to win the next election, he needs a peace deal in Ukraine. That would help him. That's probably good for 3 to 5% of the market, probably.
Okay. So you've contextualized it then well, which is, I'm going to say the macro story over time is not going to be that impacted. No. By a peace announcement.
No,
Ukraine probably would be if the war escalated even worse, right, and spills out in other places. And dear God, hopefully it doesn't. But right.
Yeah, if that happens, own defense stocks. That's what you want to own. They'll make all the money. Economically, it's not that big of an impact. The economic issues that we have here are functions of what we've done to our economy, and we're going to have to live through that process, whatever that is. Just alleviating that potential threat is going to give a sigh of relief to the markets, right, temporarily. And again, just like when Russia initially invaded Ukraine, the market sold off pretty sharply. I think we were down like 3% that day, and then we had completely recovered that and more in the next 3 days. So it was a very short, brief concern when we entered the war. And so coming out of this, there'll be a kind of a short-term sigh of relief. We'll get some money flowing into the markets for that. Defense stocks will probably sell off some because, well, the war's over. But then we're going to pretty quickly focus back on Fed and economy.
Okay. All right. Well, look, let's roll up our sleeves here and go through some data for a moment. Okay. So you and I have talked, as I said, for many of these videos about the jobs market, and how the numbers, particularly those that are reported by the government, just do not seem to map very well to the developing situation on the ground that we've been tracking now for, a year plus, but certainly in the past year as layoffs have started and the economy started slowing and all that type of stuff, right? Let me just go through some numbers that were released just this week, right? So we had the job openings numbers, right? The JOLTS. I'm just going to quote this article here for a second. After 5 consecutive beats of expectations and an unprecedented 27 beats in the past 29 months, this is why you and I were so skeptical of all this. February is when the BLS seasonally adjusted BS finally came crashing down. And not only was the February print below all sell-side estimates, but it was the 3rd biggest miss of expectations on record. Okay. So we had a big, massive whiff on job openings. ADP, its payroll data, it did increase by 145,000 jobs last month, but that was a big miss versus expectations, right? Then we've had initial and recurring claims. You mentioned these briefly. Initial jobless claims soared to 228,000. This is the 9th straight week with initial claims above 200,000. Continuing claims surged above 1.8 million, its highest since December 2021. Right. So all of a sudden, we're looking at all of these jobs indicators, and we're finally starting to see bad numbers here. Right. So too early to say, oh, the situation's entirely changed, but you and I have been calling for this for a long time, and we're finally beginning to see data that begins to comport more with the reality that we've been tracking on the ground. I want to put up one chart here. Zero Hedge shows this often. It's Bloomberg data. It shows the labor market surprise index, which is a government reported number, versus the US surveys and business cycles surprise index, which just is more sort of boots on the ground data. And these charts have been diverging now for months and months. And the question's been, okay, they're supposed to be tracking the same thing. When do they start to close? And you can see here in the latest data set on this chart, finally, the one that's been much more positive, trending in a positive direction, has now turned negative, and the trajectory, at least, is now downwards towards mapping to much more of the reality-based boots on the ground data. Again, for early change in the series data here, so we'll keep tracking this. But this is what we expected: is that at some point those too good to be true government numbers were going to be proven to be fiction, and things would come crashing back down to earth. So reaction.
And look, the employment numbers out tomorrow morning. Don't be surprised if that's a little bit stronger than the ADP report. That's been the trend lately. We'll see. I mean, I think there's a reasonable possibility that number could come in weaker than expected, but I thought that for the last couple of months, and it's coming consistently stronger as well, because again, it's just, as you said, the data really doesn't line up with what we're talking about going on in the economy. What's going to be interesting to watch, and nobody's going to know this, and nobody's going to care when we get there, but I'm really interested when we get in June or July, we will get the revisions to last year's employment data. And it'll be very interesting to see what those revisions look like, and if they're sharply negative or not. So, those, and again, nobody cares about the revisions when they come out. They just get glossed over and nobody looks at them. I do. But the next, this June and the next June, I think we could see some pretty serious negative revisions to this data.
So there was an article I read recently, and I couldn't find it in advance of this recording. But it talked about, kind of the procedure that the Bureau of Labor Statistics uses to compile a lot of this jobs data and some of the other government entities. And they take sample data, and then they basically run it through their models to come up with the ultimate number. And they basically sort of admitted through this whole process that like 80% of the numbers that are reported are just all estimate based.
Yeah.
Where they're like, look, we really don't know, right? So we have our models and our assumptions, and the number that comes out, about 80% of that, only about 20% is based on real data inputs, and 80% we're kind of just giving our best guess. So it could be wildly wrong. We don't know yet until those big revisions come out.
Well, and we've seen those data revisions before that have been wildly wrong. So it's like they go back and they say, 3 years later, we wind up and we go back. It's like, oh yeah, we thought we had 1 million jobs created back in 2012, and it was actually only 100,000 or whatever it was. Big differences. Now at the time, had we more accurate data, markets would have probably performed differently. Fed actions may have been very different at the time. But again, because of the way this data comes in, again, think about it, you're calling 60,000 households once a month going, hey, are you employed? And then you're extrapolating it out to 330 million person population. I mean, how accurate? And then you're making up numbers for births and deaths of businesses.
Right.
How accurate is that going to be? And that's why I say, you and I talked about this before. I don't understand why they just don't take a sampling, call Paychex, call ADP, call 5 other payroll companies in the country. Say, how many people did you hire this month? How many people did you fire this month off your payroll system? That's a pretty damn accurate set of data. And I just don't know. I mean, it's 5 phone calls versus 60,000.
Yeah. So, and in a digital economy, in a blockchain world, we should be able to track kind of everything at this point and take a lot of the guesstimation out of it, but whatever. Well, look, important point to underscore that you made is that, the Fed is using this data in setting policy. And we have warned that it is lagging data to begin with, right? So it's already, you're starting looking in the rearview mirror, but a lot of it could be erroneous, right? So it's like looking in a rearview mirror that's just like spider webbed with cracks and has, distortions and, all sorts of things. So when we talk about the fact that the Fed could be over tightening here, I understand their desire to be more conservative when it comes to fighting inflation than not. But still, if they had had truer data, they might have decided to pause, several hikes ago or whatever, right? So it's worrisome that the most important decisions in the world, at least economically speaking, are being made with such suspect data. One thing I want to note about this too is we've talked about the hope cycle, right? Which is housing, orders, profits, employment. And these are kind of the dominoes that fall as you go into a recession, and they fall in that order, right? And employment, as we've talked about, is one that moves last because companies are so reluctant to fire people because of the investment they've made in finding them and hiring them and training them and all that type of stuff. It's now all of a sudden looking like, what had been giving the administration and the Fed and a lot of other leaders who talk about the strength and resilience of the U.S. economy, a pillar to stand on to make that claim was the strength of the employment market. Well, now that domino, it looks a lot more wobbly than it did just a week or two ago. And obviously, you and I think it could be pretty wobbly already. It's been masked, right? So we're going to find out exactly how vulnerable it is. Obviously, if that tips over, that does really open the floodgates to the recession risks that you're talking about. I also want to flag for folks that after a long time of tracking him down and working with his schedule, I will be interviewing in about a week and a half Michael Kantrowitz, who is the analyst that put together the Hope Cycle framework. So we'll actually have him here on the program and get to hear from the horse's mouth what he thinks on each one of those, the H, the O, the P, and the E, and where they're headed. Real quickly, I just want to make some quick comments about the ISM and PMI data we talked about. So you were right, Lance. Manufacturing survey dropped to 46.3 from the prior month, where it was 47.7. It's the lowest level since May 2020, when the pandemic was slowing down much of the U.S. economy. So that is not a healthy indication result. And the ISM survey showed all subcomponents of its manufacturing PMI below the 50 threshold for the first time since 2009, right? And if you're below 50, you're in contraction, right? So we're seeing like pretty bad recessionary readings on this stuff now. It's not like it's beginning to get bad. It's like, hey, we've only seen readings like this when we've been in a recession before. So we'll see what happens there. Last point I want to make on the data, layoffs. You and I talk about layoffs all the time. Challenger Gray and Christmas just came out with this comment about the tech market, where they've said the technology sector companies have announced over 100,000 cuts so far this year. That's on pace to surpass the highest annual total for the sector announced in 2001, right? So we're seeing .com bust layoffs in the tech sector right now. And as those of us who lived through it knew that was a nuclear event for the technology sector, right? What's different this time is 2001 was much more localized in terms of what parts of the economy it hit. Technology obviously got hit the worst. We're now beginning to see this spill out into all sorts of other sectors of the economy here. And it looks like that wave is still building in intensity from here. But the tech sector itself is already kind of getting to that sort of nuclear state that it was back in the .com bust. So lots of data there. I guess, sorry, there's one more other note I had here that's worth talking about, which is small businesses. I know you're laughing, but these are important because they're telling basically that this is a emerging pattern.
Yes.
UBS Evidence Lab shows that private bankruptcy filings in 2023 have exceeded the highest point recorded during the early stages of the COVID pandemic by a considerable amount, right? The 4-week moving average for private filings in late February was 73% higher than in June of 2020. So small businesses got totally decimated by getting shut down during COVID. Now they're struggling to get back on their feet. And then all of a sudden, we're seeing all the issues that we've been talking about here, particularly credit contraction, which I'm going to talk about in just a second, is beginning to really nail them. So they said this is bad, but the administration is set to raise the corporate income tax to 28% sometime in the coming months. the tax hike will affect small businesses at a time when credit conditions continue to tighten. So, I mean, we have just been like pummeling small businesses, which, as you and I know, Lance, are responsible for the vast majority of job creation in the US here.
Yeah, the NFIB survey tells you that story very clearly. It's at its lowest, one of its lowest readings on record in terms of small business confidence, and that has a very high correlation. I've talked about that with you before. Has a very high correlation to the ebb and flow of the small cap index, which has likewise been under pressure over the last couple of months.
Okay, so does sort of everything I just go through, does that add validation to your general comment you made at the beginning of this discussion of like, look, I know the market is telling us it sees sunny skies ahead and we've got all those bullish indicators green across your dashboard, but like it's hard to see that continuing through the year with all of these macro issues coming.
No, that's so. But here's the question that we have to ask, right? So markets are predictors of future economic growth, right? So the markets tend to bottom 6 to 9 months before the economy historically. Okay, so the question we have to answer is, so ISM manufacturing 46.3, lowest level since March 2020. Is that near the bottom, right? Or are we about to start seeing, hey, have things gotten negative enough that we're now start to seeing improvement? So think about how the economy works. Is that I buy a bunch of stuff, and then so the economy's growing, and then I stop buying stuff, and the economy slows down. But after a while, I've got to buy some stuff, right? Because, maybe I stored up a bunch of bottled water in my house, but eventually I'm going to run out of water and I've got to go buy some more water. And so that the economy ebbs kind of over time. So the question becomes, are we closer to that nadir of the economic data, that economic trough, and we're about to start seeing some improvement just from a normal economic business cycle? Or are we just on the cusp of things getting worse, right? That's the answer we don't have, and we won't know. And the question is that what the market's trying to tell us? I don't know that answer. I think maybe the markets are just being optimistic. We'll see.
Yeah, I do too, and that's a great point. Which is we got to say, yeah, the data is really bad now, but maybe this is as bad as it gets, right? And then the market is already pricing out beyond that. I would just love to see some forecasts or data that suggests that, but besides sort of the analysts increasing their earnings estimates for reasons you and I can't really understand at this moment in time.
Well, the Bloomberg Economist survey or improving economic data is saying it's going to get better. So
what are they citing? Do you know?
No, they're making their assumptions that, pretty much Q2, Q3 is the bottom of the economic trough.
Yeah. Well, and it could be okay. So,
I'm saying that. So I'm not saying they're right or wrong, and I have no basis for how they arrived at that conclusion. That's just the conclusion they have.
Yeah. And again, this is just sort of the risks that we have to be open to as investors, right? Where we can say, look, we're looking at all the data we can see, and it's really bad. But you just gave a good reason for why prices could still go up from here, right? It's because that said, the trouble I have with that is what we're talking about could be coming, right? I can make an argument that the magnitude is going to be pretty bad, right? Yeah. It's going to be pretty painful for a lot of people. I don't feel like the market's corrected enough to make up for that, right? Like you could say, oh, the markets were down 20% last year. And I'll say, yeah, but you know what? They were ridiculously overextended, right? Yeah. And I think that, we just took the top of the froth off, and I could still have made an argument at the beginning of this year that we had a lot further down to go just from a fair value standpoint. So I don't feel like we've had a recession priced into this market yet. Obviously, I could be wrong, but what do you say to that?
I think you're absolutely right. That's the conundrum, right? That's the whole big challenge of trying to manage money in this market. Where do we put it? Are the fear mongers right, and things are going to get drastically worse, and we need to be, in bunkers and beanie weenies and gold? Or are the markets right and things are about to start improving? That's the bet, right? We've got to pick one side or the other eventually. And, that's part of navigating how we get through this market. I don't have the answer. I wish I did, but I agree with you that, the economic data certainly looks like that we haven't done enough correction in the markets yet to accommodate for a further economic slowdown. Just strip everything else out. just the function of higher rates and the impact on the debt-laden economy.
Right.
That's it. So yeah, I don't think the markets have corrected enough. Maybe I'm wrong. And it's quite possible I'm wrong about a lot of stuff. So
you're like me with housing, where I'm just like, look, I can list off a long litany of reasons why I think housing is going to go lower. But if I just start with the fact that mortgage rates are twice where they were a year and a half ago, like, I feel like that's an argument enough that it should still be a lot lower.
But yeah, I agree with you. And like, I told you, I just bought a house recently. There's been 3 houses that have sold in that neighborhood since I bought my house that are selling at higher prices than what I paid for. Prices are going back up in that neighborhood already.
Well, but yours was like a stink pig, right?
No, it wasn't terrible.
It wasn't terrible.
Okay. I know I lowballed the offer. I got a really good deal in this house.
Yeah.
But what I'm saying is that, mortgage rates have come down a little bit because 10-year treasury rates have fallen, 30-year treasury rates have fallen. And so just that little bit of a decline has already lifted housing prices in that neighborhood.
Oh, yeah. Ridiculous. Right.
But that's what I'm saying, though. But it's that shouldn't be happening, right?
Right.
That doesn't seem logical in this environment.
But it is, meaning it doesn't matter what you and I think, that is the going price for a house in that neighborhood right now, which is what you do such a good job of reminding us as investors that we can't be too lashed to our dogma, because at the end of the day, the market doesn't care about it, right? And so you have to deal with the markets that you have in front of us. The other thing that you really laid out there well, Lance, is that you have a tough job. I'm glad I don't have it.
That job is for sale anytime they want, and it's cheap. So anybody that wants my job, you're more than welcome to it.
All right. Well, look, we're going to start wrapping up here. I am going to get to your trades real quickly. I just wanted to do a little sort of mini rant with you. So you moved relatively recently, right? You sold your place because you thought that the market was going to come down, and it looks like it did enough for you to get a price you wanted for a house, right? And then you're going to be moving again at some point when that house is move-in ready.
It's going to be about a year.
Okay, but my point is you still have like your move still in your short-term memory. I'm going through mine. I'm not looking for sympathy. They do
Good,
suck.
I'll give you.
They do suck. The point is going through a move is a great experience for just reminding us that the average, Westerner just has too much damn stuff, right? Like, my wife and I don't think of ourselves as too materialistic or having too many material trappings, and we're still just shocked at how much stuff is going into boxes. And we're really using this as a time to purge. I put some tweets out on Twitter as sort of sharing my thought process as I go through this, of really trying to zero in on what are the things we really truly value, want to hold on to, and can we just try to get the rest out of our life, right? But this whole sort of minimalization movement, right? The Marie Kondo, style of, if it brings you joy, great, but if it doesn't, get rid of it, right? It is really important, like our stuff to a certain extent does kind of own us. And you really feel that when you got to lug it somewhere new, right? But I'm raising all this because I know you've just recently gone through it, and I'm curious to see, what your perspective is on this too.
Well, we have so we've moved multiple times over the years for different reasons, and every time we move, we go through this same process, and because we accumulate stuff. We have 4 kids, so we accumulate stuff, right? It just happens. But every time we move, everything we touch, if we haven't touched that item in 6 months, it gets thrown out or sold or something, right? It gets disposed of. So, the theory is that we collect a lot of stuff that we hold on to emotionally. It's like, oh, I may need that someday, and you never know when. And normally stuff I get rid of, I need like the next month, but
yeah, and that's Murphy's Law.
That just happens. But the idea is simply that we try to let go of stuff, because it's really easy to keep, stuff around. Oh, I may need that someday, or I bought that because of this reason or that reason. And you wind up just, with a bunch of stuff you never touch or use. So we have a 6-month rule. That's our, if we haven't touched it in 6 months, then it's got to go.
Yeah, that's a great rule. Now, of course, there are certain things that, I don't know, family heirlooms, whatever, that, are hard to part with. But we pulled a bunch of stuff that we had sort of like an unfinished basement that we have was sort of our excess storage, right? And I'm pulling stuff out, and I'm like, wait a minute, to your touch point, I haven't touched this in over a decade. Like, why does it need to come with me?
Gotta go.
Gotta go.
It's interesting too. I mean, I had a whole library of books that I have accumulated over the years. I had every finance book you could probably imagine ever wanting to read. And I've read them all multiple times. And when we moved from this last house, I was like, because once you get a box of books, they're heavy as hell. And I had like 30 boxes of books. I was like, screw that. I am not moving these boxes. And I sold them all. So
that has been the hardest one emotionally here for me is books. And I know I'm going to get a lot of blowback from the book lovers here, of which I am a huge one.
I'm a huge book fan, huge book fan.
But in the era of the Kindle, right, you're like, literally, I can have all of those on this one little thing, right, that is instantly accessible to me anywhere, right? And yes, there's the nostalgia and there's the feel of the book in your hands. And there's just the emotional relationship you had with that volume as you were reading it, or it was the one that was given to you when you were a kid that you've treasured your whole life. But to your point, like, they just take up a lot of space. And most of the time you were not reading that book. Like,
well, I know that was really what I came down to is that I had this wonderful library. Like, you came up to the upstairs of my house, I had 2 walls of just solid finance books about everything you can imagine. And what I realized is I hadn't pulled one of those books off the shelf in 2 years, because when I needed something, I would, go look up one of my old articles where I had quoted something out of that book before, or I would just look it up online and get the quote I needed from the book. So it was like, why am I lugging these things around? Because all the data is out there somewhere now. I can just get it. I know that's lazy, and I haven't got to Chat GPT yet. So that may be the next invention, but yeah, I mean, it was hard to let go of those books because I had, notes and highlights and all kinds of stuff. And, it was hard to let them go, but it was better than hauling them around at the end of the day.
Yeah. It's a real heartbreaker, but, I will say, when you make the decision to let it go, and you just did it with all those books, you said, right? Like, it is freeing, right? I'm assuming you're not regretting that decision.
No, absolutely not. And, after I did it, it was hard. And then now I look back and we made the move. I was like, it's so nice not to have to haul all those books around again. And now I don't miss them. I don't, even think about it anymore. It's out of my life. So,
right. And spatially, you don't need that requirement of, I need a place that has, 2 rooms full of bookshelves for all these books anymore. Right.
Yeah.
So
Absolutely.
I know we're going to get some pushback from book lovers, and I get it. So last point on this is I just want to let folks know.
Just real quick, my wife.
Go ahead.
I was going to say, my wife makes sure though that every time we move that I touch her before we move. So.
Yeah. Does she have like a 6-month reminder on?
She's like,
that doesn't touch me in 6 months. I'm in danger here.
I'm teasing.
That's super funny. All right. So just want to let folks know that one of the bigger personal finance celebrities right now, we all know people like Susie Orman or Dave Ramsey, right? They're like celebrities in this space. A newer face in this space is a guy named Ramit Sethi. You probably heard of him, Lance, but he's got a ton of followers now. He's actually got a new Netflix series on wealth building that's about to launch. I just landed him for an interview on this program, and I'm really looking forward to kind of hearing all of his best practices for building wealth and all the common mistakes people make that sabotage their progress and all that type of stuff. Total expert on all that stuff. But I am really interested just to have him address the question of, hey, what does wealth mean to you, right? Because he's, I think, got a great perspective, like you and I talk about a lot, Lance, where like, hey, yeah, money is important, but it's only one component of wealth, and there's a lot of other things that are just as, if not more important, like your health and your relationships and all that type of stuff, purpose in your life. But really looking forward to his commentary on that. And as I've been just deciding what to do with all this stuff and realizing it's quote unquote wealth or things I own, but it really diminishes from my happiness and doesn't add to it. I don't think it's really true wealth. So anyways, I want to let folks know that Ramit's coming on the program, and then I'm really excited to kind of delve into that territory with him. All right, as we wrap up here, Lance, trades for the week. Has it been a busy week for you guys?
No, not really. Not too busy wise. We increased our equity exposure. Back when we got buy signals about 3 weeks ago, that's worked out well. Markets have been going up, and like I said, recently we've been adding to our bond positions. So just slowly stepping in, increasing that bond duration. Eventually, the bulk of our trades will be on a longer duration side. of our bond portfolio. But again, we're just moving slowly, taking our time right now. I think we've got plenty of opportunities for things to pull back. Like I said, if you want to own gold, gold's very overbought right now. Look for a pullback to buy gold. Bonds are a little bit overbought right now, but on a very bullish signal. So wait for a little bit of a pullback here, add to your bond portfolio. So that, if you just let the markets give you opportunities, you always make a better trade over time.
All right, good. Well said. Well, look, a great reminder too, Lance, of everything that you've laid out in this very chart data-rich discussion we've just had here. There's a lot going on in this market. It can be really daunting for the average investor to try to take all this data in and figure out what to do with it, especially when you sort of describe right now, we have a market that totally wants to party, but experienced sort of market watchers like you and I feel like we hear the cop sirens on the way, right?
Exactly.
So, it just can be super hard to know what to do in this type of environment. So I'm just going to get on my soapbox for a second and repeat my, standard advice for folks to, most people, especially if you have a regular life that understandably deserves the majority of your focus, rather than what next asset to buy and focusing on that, really try to focus on picking the right professional financial advisor to be your guide through all this, one that can create the personalized investment plan for you based upon your risk tolerance and your goals and your needs and all that type of stuff. But more importantly, in this type of fast changing and uncertain environment, can be the one executing it for you, right? Obviously keeping you well informed, but as events and developments change on the ground, they can be the ones making the changes in your portfolio for you. If you have a good one who's already doing all that for you, excellent, stick with them, absolutely. But if you don't, or if you'd like the input of one who does, maybe even Lance and his team there at RIA, just go fill out the short form at wealthion.com to fill out that form and get a free consultation with these guys. Doesn't cost you anything, no commitment to work with them. They just offer it as a public service. All right. Well, look, Lance, as we wrap things up here, obviously, whatever the markets do next week, we'll be back here deconstructing it for folks. But any parting words for folks right now?
Just one. Have a wonderful Easter holiday. Enjoy your family. We'll worry about this stuff next week.
All right. That's great. Great perspective. All right, folks. Well, look, if you've enjoyed this weekly market recap with Lance and like to see these things continue in the future, please do us a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, thanks so much, buddy. Everybody else, thanks so much for watching.